at the different stakeholders in the business and how do we govern a corporation in a way where we can balance the rights of all these stakeholders. Now, of course, the biggest and most important stakeholder is the shareholder, right? And then you have your providers of capital, which are the other providers of capital, which is providers of debt. So shareholders are the provider of equity. They have the biggest stake in the company, followed by providers of debt, which also have a significant stake in the company. Now, what happens is that these guys, the shareholders, then appoint the board of directors, because a company can have hundreds of thousands of shareholders. They're not all going to be actively involved in the governance of the company. So they appoint shareholders based on their voting. They appoint board of directors based on their voting, and then those board of directors appoint managers such as the CEO, the CFO, etc. And those managers are going to be involved in the day-to-day running of the business. Now, it's very important from a corporate governance perspective that the interests of these three parties is aligned. Now, what do you think the shareholders are most interested in? Obviously, profits, right? And therefore, we should give managers something of a bonus, right, in addition to their fixed salary, so that if we only give them a fixed salary, then they will not take any risk. They will not try to increase the profit of the business. But if we give them a bonus, right, then they will, which is linked to the profit of the company, then they will try to have a large profit. But at the same time, we should give them a fixed salary so that they also take care of the creditors. So the compensation of the managers has to be very delicately managed, that they should be having a partial fixed compensation and a partial variable compensation, so they are able to balance between the needs and wants of both the creditors, which are getting a fixed payment, and the equity holders, which are getting a variable payment. And since it is the board of directors that chooses these managers and decides their compensation, it is very important that in the board of directors, not only do we have representatives of the shareholders, but we have some people who also are looking out for the interest of the debt holders. And who is this person? Who are these people? They are called independent directors. Independent directors. This is a key concept in corporate governance. Now, independent directors are people who are not the shareholders, and they are also not your management. So if somebody from the CEO or CFO is sitting on the board, right, if they are sitting on the board, then we call them executive directors. Executive directors are people who are working for the company in the senior management, and they are also sitting on the board. But they are going to be more inclined towards maximizing their salary and their bonus, right? If you have shareholders sitting on the board, then naturally they're also going to be trying to increase the risk and trying to get a higher profit. So to protect the creditors, what we want is independent directors. And these independent directors are also going to be taking care of the other stakeholders, such as employees who are junior employees who are not getting so much bonus. They're mostly getting fixed salaries. So they also don't want to take too much risk. So somebody has to look out for them. Somebody has to look out for the customers so that they keep getting good quality products on time, because they depend on the company for their products. The suppliers depend on this company for their business so that they can keep supplying and keep getting their payment on time. And of course, the government has to get tax from this company. So it is also a stakeholder in this business. So this is the big picture of your corporate governance. So first of all, you have the providers of capital, which are your equity holders, and your debt holders. Then they appoint the board of directors. Well, it's the equity holders that appoints the board of directors, who then appoints the managers, who then appoints the employees, and then the employees serve the customers, deal with the suppliers, deal with the government and the regulation. And this is how the whole thing works. But the key is that in your board of directors, you have to have some independent directors. That is the key, because these guys are the ones who are not going to take any one stakeholder's side over the other. They're going to create that balance, which is the key. And this is how we have moved from the shareholder theory to the stakeholder theory. So, in the old days, before the famous case study of your Enron, and their auditors were Arthur Anderson. So, there was an accounting firm called Arthur Anderson. This was one of the big five. So, now you only have big four, which is PwC, KPMG, Deloitte, and which is the fourth one? KPMG, PwC, Deloitte, and Ernst and Young, EY. Right now you have these big four left. They used to be big five. Arthur Anderson was the fifth, but Arthur Anderson is there no more after the Enron scandal, right? And clearly there was something going wrong in the Enron. If you are interested, you can watch a movie called The Smartest Guys in the Room, and it will tell you about what happened in the Enron scandal. But the old school of thought was the shareholder theory, that the company is just made to make profit for the shareholders. And then now what we have is the stakeholder theory, that hey, shareholders are not the only stakeholder. There are other people who are also having a stake in a business, such as your banks, which have given a loan to this company, right? There are employees who depend on this company for their livelihood, suppliers, customers, as we just discussed. So, who's going to take care of these people? So, because if you follow the shareholder theory, then the company has been made only for one single purpose, to maximize shareholder returns. And okay, they'll take care of other stakeholders as long as it serves to increase the shareholder value. Well, that theory is now out the window, and now what we have is the stakeholder theory, that you have to consider the interest of all the other stakeholders as well. And you have to give more of an importance to environmental factors. This is something we've just been ignoring all these years, right? So, social factors in terms of gender diversity, in terms of taking care of your customers' rights, the customers' data, all these people related things, right? All these planet related things. So people and planet is something that we need to take care of. And of course, you have finally your governance factors that you have to balance between all the stakeholders. And we will now talk about each group in detail. First, shareholders. Obviously, these are the guys that own the company. They get to vote, they get the dividends. They are focused on growth because they want to maximize the value of the company. Then you have your providers of debt. Now, there are two types. Either you can get a loan from the bank, right? So, banks and private lenders. The other one is a company can issue bonds and get money from public markets by issuing bonds. So we're going to look at this later, the bonds part. Right now we're focusing on the bank part. And when a company gets a loan from a bank, it is a different kind of a deal compared to bonds, because the bank knows inside information. The bank is going to take your inside information. They probably are going to even find out about your profitability before you even publish your financial statements. Right, so banks have a lot of inside information, so they don't have this information asymmetry, which means unequal information. That case is not there with the banks. But however, when we will talk about the bonds next, then we will find out that they, of course, will only find out, the public investors in bonds, they find out the information once it's published. So, as compared to public debt holders, banks can exert a significant degree of influence on the company. Not only because they have that information, but because they are hand in glove, they are more closely connected with the management. Therefore, you can say that they have a relatively lesser risk because they're really focusing on the business, and they're also taking collateral. So they usually take prime real estate as collateral. In case the company is unable to pay back, then they can sell that real estate collateral and recover their money. Some banks even take interest in equity positions, so they'll have some debt and maybe some equity positions. Some banks I've seen is that they even convert part of their debt into equity if the company is unable to pay on time, and they do that very interestingly, happily, because they are looking for that upside. And I gave you an example of this debt taking over the company where the assets were going down from 20 to 9, right, when the existing owners were getting wiped out. So some banks are aggressive like that. However, if you compare them to providers of debt which are public, that these guys are buying the company's bonds. Now think of Amazon. Now Amazon might be getting some loan from a bank. That bank will be much more closely monitoring this compared to if some individual is buying the bond issued by Amazon. This individual has no idea what's going on inside the company. They only rely on public information and whatever credit ratings, and credit ratings you'll learn more about in fixed income. But there are companies like Moody's or Fitch or S&P that provide ratings about a company. Let's say they'll say Amazon is AA, which means it's very good because AAA is like the best, US government, and then AA, and then A, and so on and so forth. But the point is that public investors only rely on public information, whatever the company is issuing in terms of its financial statements, and also what these credit rating agencies are sharing in terms of their ratings. And what do these guys get? These public debt holders, they get their periodic interest payments and the repayment of principal at the end. They are not shareholders, they don't get any voting rights, they have limited influence over the company's operations, and they just want to play it safe. They want to minimize the risk, the downside risk. They prefer stability in the company's operations, and they want their payments on time. This is obviously a conflict with the shareholders because shareholders will want to take higher risks for higher potentials because they have, of course, an unlimited upside. Now coming to the board of directors. Board of directors is elected by the shareholders through their voting, and then this board of directors is going to come in, provide strategic direction, and then monitor the company's operation as per the strategic direction provided. And to be able to do that, they're going to, of course, hire a CEO and then the rest of the management. Now, of course, the shareholders are going to be bringing in their inside directors, but what the government or the regulators, such as the SEC, will want is that there should be independent directors on the board. This is the key to corporate governance, because there is no other way for you to make sure that a company balances between all the stakeholders, because of course the inside directors are going to prioritize things for the shareholders. And then you're back to the shareholder theory. So if you want to be at the stakeholder theory, the only way to do that is through independent directors. So inside directors are major shareholders, founders, senior managers, and senior managers have a special name. They're called executive directors because they are part of the executive management, and if they're also on the board, then we call them executive directors, right? Now the rest are going to be non-executive, but non-executive could be shareholders or could be independent. So an independent director is two things. They are not a shareholder and not an executive either, right? They are completely independent, and they're not just some Tom, Dick, and Harry. I mean, they have the required expertise, so they are chosen for experience of managing and directing other companies. They're qualified people. And International Financial Corporation, IFC, does some very interesting work in terms of your corporate, that they have this director training program. So then these directors that are coming up as independent directors, they are qualified for the job, right? And one of the platforms through which they are qualifying is the International Financial Corporation's Director Training Program. And that's just an example. It's not in your curriculum. I'm just giving you an example. But IFC is active in this space. All right. So there is no set standard that how many independent directors should you have, but there is certain unspoken sort of standards which are now slowly maturing, and ideally what we want is one global standard. It's not emerged yet, but hopefully soon we have a global standard for this, that at least one third of the board should be independent. And more important than that, in your board of directors, what happens is the board doesn't always do everything together. It breaks up into smaller committees, such as the audit committee will be responsible for making sure the financial statements are good, free of material misspecification. You will have your remuneration committee, which is going to decide how does the management get their compensation, right, etc. So the chairman of the audit committee should ideally be independent director, right? Or at least, even if the chairman is not an independent director, you should have a decent number of independent directors in the audit committee, because that is a key committee to make sure that there is no financial fraud going on. Another important concept is your staggered board. Now, what happens is you cannot vote all the board of directors out and new ones in at the same time. So let's say there are 6 people on a given board, and there is a shareholder that wants to come in and take over this company. They will not be able to change all of the board at the same time. Maybe it will be like you can only change 2 at a time. So in the first year they'll be able to change these 2, but the remaining 4 will still have 2/3 majority, and the new shareholder will not be able to do what they want, right? And then, okay, maybe next year they will be able to do it, but it's going to take them at least 2 years to do that. So this is an example of a staggered board. So on one side it is good because it gives you a sort of a consistency of the strategy, a continuous strategy implementation. Nobody can just come in and create a kind of a volatility. But at the same time, it slows down the shareholders' ability to have an immediate impact once they get major control. So they are going to, this is obviously having its pros and cons. Next, moving to managers. So managers are obviously your senior management, CEO, CFO. CEO is of course going to lead them, and they execute the strategy which has been set by the board and monitor the company operations on a day-to-day basis. It's very important that their compensation is aligned with the shareholders, so they should have a fixed salary but also a bonus linked to the profit of the company. So a kind of an equity option, you can say. If the stock goes up, then their compensation is linked to the stock price, and they get stock options based on that. So let's say a company has stock worth 50 and you tell the senior managers that, hey, we will let you buy this company's stock at 60, and what they will do is they'll try and make it go up to 80 so that they can buy at 60 and then sell at 80, right? So then you are basically aligning the interest of the shareholders with the management. Employees, however, lower level employees, they just get fixed salary. Equity ownership is a very small part of their compensation usually, and they are more interested in just stable long-term stability and survival, and a modest amount of growth as well. Customers, again, they want a good quality product for a good price, product or service, whatever, and they expect after sales support, warranties as promised, and they are definitely one of the stakeholders that would be interested in a stable company, but compared to the other stakeholders, they would probably be the least concerned about a company's performance because they can just buy their product or service from another company. Suppliers, on the other hand, have a little bit more interest than the customers, because they have probably got some kind of business going on with this company and they would like to maintain a long term relationship. And of course, your government, which collects tax, so they will be interested in the well being of the company so that they can keep getting tax from not only from the company itself but also from its employees. Right. So now let's talk about environmental, social, and governance factors. And the first thing here is that governance has been getting a lot of attention, especially after the Enron scandal. And we had this whole law passed in the US. It was called the Sarbanes Oxley Act. For short, we call it SOX. SOX for the S and the OX. So SOX was passed after the Enron scandal, and corporate governance has evolved considerably. There's definitely still room, like for example, the percentage of independent directors and which committees of the board should have independent directors, and ideally, which committees should have chairman as the independent director. So all of this is still not standardized at a global level. So it is still evolving, but it has evolved considerably and a lot more when you compare it to the E and the S. So from ESG, governance has evolved and improved a lot. But these two, which is your environment and social, these have not improved that much. Right? Now, why is it becoming more and more important now, especially for the first E and S? Is because number one, previously they have been considered more of an externality. Now, what is an externality? Externality means something which is external to the business, right? And they've been considered negative externalities, that yes, we are doing something bad, we're spoiling the environment, we're doing something bad for the society, but it's not impacting the company's profitability, it is external to the company, so kind of we don't really care, sort of a thing, right? But now what's happening is that it is becoming internal. And I'll give you an example. There was a US company called Union Carbide, and they did something in India in a city called Bhopal. You can look into this, that there was a plant which leaked a poisonous gas, and it was a terrible incident. And then eventually the company had to pay a lot of money. So if this mismanaged ESG issue is going to be there, eventually it is going to come back and bite the company's financials. So it does get internalized. Number one. Number two, more and more people, the newer generation, they are demanding that their investments are not only invested in companies which are maximizing profit, but also which are having an impact, a positive impact on society. So people and planet are being prioritized, and that's fantastic, right? I mean, how can you say no to that? And then you've got your governments which are now taking this more and more seriously. And if you follow developments such as the forum in Switzerland, in Davos, that every year they are meeting and discussing how we can improve the situation for our planet and for the people in general. So this is becoming more and more important. It's coming up the agenda for the world powers and the important people, and not being treated as negative externalities anymore like they have been in the past. So we have obviously been ignoring climate change and air pollution and all of this, but it is now taking more of a front stage as we are entering into this next era. A very nice exhibit in your curriculum gives some examples of all ESG factors. So number one over here is climate change, and then air and water pollution, which is obviously linked to climate change. Biodiversity is that you are losing a lot of species of different animals and just different living things Deforestation is another big issue. We're cutting down forests. Energy efficiency, a lot of energy wastage is there. Other types of waste is there. And water scarcity is a big problem, which is obviously linked to your climate change as well. Because as your glaciers melt, your fresh water is going into the seawater, and then there is fresh water scarcity. In terms of social issues, this is everything related to people, whereas your environmental issues is everything related to the planet. So, people is not just your employees, it is also your customers and their data, right? And then in terms of employees, you've got gender and other types of diversity, such as racial. So, that is important. Then, employee engagement, relationships with them, their human rights, their labor standards, whistleblowing, and all this is related to your social factors. And then finally, your governance, which we have already discussed in detail. That in terms of your board composition, how many independent directors do you have? What about the audit committee? Is the chairman independent director or not, or at least a number of independent directors in your audit committee? How are you taking care of anti-bribery situations, right? What is the executive compensation? Is it aligned with your shareholders? How do you go about preventing any kind of unethical lobbying? Are you making contributions to political endeavors, and is that kind of compromising on the rights of minority groups? If any such thing is happening, is there a whistleblowing structure in your company that somebody can easily and most importantly anonymously raise the alarm and not actually have to face the brunt of it later on? So anonymous whistleblowing is very, very important here as well, right? So of course, these are just some examples. There could be more or less depending on where the company is operating, what is the business, and what is the geography in which it operates. So we already talked about all of these, and I'm just going to skip this because it's already mentioned over here. So all these points are very important, and you need to understand that what these points are from an ESG perspective. What I am, however, going to focus on is your quantification of your ESG factor. Now, this is a more of a controversial discussion, and it's not there in your curriculum, but just for your interest, Elon Musk a few months back came out and said that he believes that ESG factors are a bit of a misnomer because he was probably angry because Tesla was taken out of the S&P ESG index, whereas obviously Tesla is electric vehicle company, and they are in a way good for the environment, right, compared to your fossil fuel based vehicles. But then Tesla was taken out of your S&P 500 ESG index. And why that is because S&P 500 ESG index calculates an ESG score based on not only environment, which is one factor, which obviously Tesla probably has a high score on because it's electric cars, but then social is related to gender and diversity otherwise, and then you've got your governance factors. And other companies like Exxon, which is obviously an oil and gas company, maybe not better than Tesla as far as environment is concerned, but Exxon probably scored very high in social and governance factors. So I mean, there's the jury is still out on what is the ideal way of evaluating ESG factors and how should an analyst go about doing this. So what the curriculum is basically telling you is that you need to see whether something is material or not. And what does that mean? See, what we are most concerned about as analysts is that is there like a red flag in this business? So let's say, for example, I'm investing in an oil refinery, and that oil refinery uses a technology which is hydro skimming. Now, hydro skimming is a older type of technology, whereas the newer one is called deep conversion, and there is certain environmental regulations which are now saying we need to discontinue hydro skimming because it is not very environmentally friendly, and we have to go for deep conversion. So I need to check whether if this refinery is going to be able to convert their infrastructure from hydro skimming to deep conversion. Otherwise, what we will have is something called stranded assets, because these assets will be worthless. Once the government says, hey, no more hydro skimming, that means all this refinery assets are going to be stranded, they will be worthless, or they will be worth scrap. And I, as an analyst, would not have done a very good job if I invested my client's money in this. So that is what is the main thing, that you need to identify material risk and be aware of something called stranded assets. Once you have identified something material, then of course you have to quantify it. That, okay, if this risk comes to pass, then what will be the material or the quantified dollar impact on my cash flows, on my value, right? Will my equity get affected? And if I am a bond investor in that company, then I don't really care if the equity is getting affected, right? Because the share prices might decline a lot, but my bond might not take a hit, especially if it is a short term bond, right? Maybe my bond is maturing within the next 3 years. So I don't really care if the government is going to finish hydro skimming after 10 years, because I'll get my money back within 3 years. So all of this is, of course, subjective, depends on the case to case situation. But important thing is that you identify material risks related to ESG factors, quantify them, and know what you're getting into when you're investing in the debt or equity of a certain company which has ESG exposure. Alright, so that is it for this learning module. Let's go through the summary. So we looked at the differences of debt and equity from both an investor perspective and a issuer or company perspective, and we talked about how there is a conflict of interest between these two, because one wants profit and therefore will want for riskier projects, and the other one would prefer that they go for less risky projects. And apart from these two first stakeholders, which are the equity and your debt providers, the conflicts go on. The employees and the customers, suppliers, government will probably be siding with the debt providers, because they also probably just want a stable business. Whereas your managers, their interest, and of course, the board of directors to some extent will be aligning the manager's interest with the shareholders, because they naturally are representatives of the shareholders who need to make profit. So there's nothing wrong with making profit. There is nothing wrong with the shareholder theory that, okay, the company is there for making profit for the shareholders, but not at the expense of the other stakeholders. So you need to protect the other stakeholders, and that is where your independent directors come in. That, okay, maximize your profit for the shareholders as long as it is not at the expense of other stakeholders. And then finally, we got into ESG factors, that you really need to look out for the material risks over here. And once you find a material risk, you need to quantify it and see what it will have, what will be the effect on the company's financials in terms of both cash flow and valuation. And some of those might be very long term in nature. So if you're going for a short term investment, obviously it doesn't matter. But if you're going for a long term debt investment like a 10-20 year bond, or a stock investment, which is of course by nature having an infinite life, so definitely you will want to be more careful with the longer term risk factors here. And finally, just have a look at this chart, which lists out these examples of your environmental, social, and governance issues.